What an incredible year it's been for the stock market, right? I mean, we've been riding high, even flirting with new records. But just as we're all getting into that holiday spirit, the market seems to have hit a bit of a speed bump. So the big question is this just a little pre-holiday dip, or is it a sign of something bigger? Let's dive in and figure it out. Just look at this number. We're talking about a gain of over 16% for the S&P 500 through the middle of December. That's a really powerful performance, especially when you think about the high interest rate world we've been living in. A lot of this has been fueled by this massive wave of optimism, especially around things like AI and the tech sector in general. So that really brings us to the big question, doesn't it? After a run like that, why the sudden caution? Why is the market pumping the brakes now, of all times? Well, as you're about to see, it really all boils down to one single crucial event on the horizon. Okay, so let's dig into the specifics. To really get a feel for what's happening, we've got to look at the numbers. What you're seeing here is a snapshot from yesterday's close on December 15th, and it really paints the picture of the cautious mood that's taken over Wall Street. And yup, you can see it right there. All the major indices finished the day in the red. Now, the Dow and the S&P 500, their dips were pretty small, down just a fraction of a percent. Not a massive drop for sure, but it did mark the second day of losses in a row. The real story, though, that's hiding in that last line with the Nasdaq. And when you look at it like this, wow, the difference is pretty stark. The tech-heavy Nasdaq took a much, much bigger hit, dropping almost 0.6%. And this is the key thing to understand. This little downturn wasn't spread out evenly across the whole market. No, it was very clearly led by weakness in the tech sector. Okay, so let's get to the why of it all. Why did tech get hit so much harder? And why is the whole market feeling so jittery all of a sudden? It really comes down to one thing: anticipation. Everyone is waiting for one key piece of news. And here it is, the big one. The entire market is basically bracing for the November jobs report. You'll hear it called the non-farm payrolls data. Right now, it seriously feels like everyone is just holding their breath, waiting. Investors, traders, they're all trying to get their positions just right before this data drops. So you might be wondering, why does one report have so much power over everything? Well, think of it like a chain reaction. First, we get the jobs data. That report gives the Federal Reserve a really important look at how the economy is doing and where inflation might be headed. Then, based on that info, the Fed decides what to do with interest rates. And here's the kicker: any change, or even just the hint of a change in interest rates, can send massive ripples straight through the stock market. All this uncertainty also leads to something called profit taking. And it's pretty simple, really. After the absolutely incredible year that tech and AI stocks have had, some investors are thinking, you know what? I'm going to sell some shares and lock in those profits. It just makes sense. And this is especially true for tech stocks because their value is often tied to profits way out in the future. And when interest rates are higher, that future money is, well, it's just worth less today. But if you look under the hood of the market, the picture gets a lot more interesting. This really wasn't some market-wide panic. Get this, while a few of those giant tech companies were dragging the whole index down, most of the stocks in the S&P 500 actually went up. What we saw was investors rotating their money. Sectors like energy and materials did pretty well, and a lot of money flowed into traditional safe havens like gold and silver. All right, so that's where we stand right now. But what happens next? Well, everything depends on what that jobs report says. The market could really go down one of two very different paths to end the year. And these are pretty much the two main scenarios everyone's watching. On one hand, what if the report comes in too hot? That means job growth is way stronger than anyone expected. That could actually spook the market because investors would worry the Fed has to keep interest rates high. But on the other hand, what if the report is just right? Showing the labor market is cooling down a bit but not collapsing. That could be the absolute perfect news, the kind that reassures everyone and sparks a huge relief rally. And hey, on top of all that, let's not forget about a classic seasonal trend. It's called the Santa Claus rally. History shows us that more often than not, stocks tend to rise during the last few weeks of December. So there's this potential historical tailwind that could give the market a nice little push, as long as that jobs report plays along, of course. Okay, so let's zoom out for a second and look at the big picture. It's so easy to get caught up in these day-to-day jitters, right? But it's really, really important to put this little dip into the proper context. And really, this is the main takeaway. Think about it. After a massive 16% gain this year, a little pause isn't just normal, it's actually healthy. It's a great reminder that markets just don't go up in a perfectly straight line. A pullback like this lets the market kind of catch its breath and digest those gains before maybe getting ready for the next move up. Which, of course, leaves us with the one crucial question. The stage is totally set. All the players are in position, and everything is hanging on this one report. So, are we set for that classic Santa Claus rally to end the year, or is the market about to get a little bit of a winter chill? I guess we're all going to find out very, very soon.